historically, Bitcoin has been one of the purest liquidity plays. So when you look at various measures of domestic or global liquidity, generally when liquidity is rising, that's pretty good for Bitcoin. And when liquidity is falling, Bitcoin's usually either going down or sideways. And starting around the beginning of Q4 of last year, some of the liquidity indicators started to bottom and turn back up, at least temporarily. And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then, if not for the whole FTX debacle. And so that kind of delayed the rally, but with that somewhat resolved, and now kind of moving forward, I think Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally. And so basically liquidity indicators look okay for the next couple of months, but overall long term, they're still not in a very good place.
Bitcoin still risks considerable danger in 2023 as macroeconomic conditions dictate price action. According to famous economist Lyn Alden, Bitcoin staying bullish after its January gains. Lyn Alden came to the world of finance via an engineering background and now runs a highly regarded equity research and investment strategy firm. Large traders, often called whales, are staying on the sidelines of the Bitcoin market despite a risk reset in traditional markets because thin liquidity is making it difficult to buy or sell the coin without affecting its price. In signs of the increasing appetite for risk, stocks have gathered upside traction while the US dollar has taken a beating on optimism that China's reopening is gaining steam and the Federal Reserve may be close to winding up its liquidity-tightening cycle. In crypto market depth, a measure of an asset's price resilience to large orders is relatively low and discouraging activity. According to recent reports, large order of the same USD value or size placed today will have more than twice the impact on price in contrast to 2 months ago, as crypto pundits typically keep track of the 2% market depth to assess liquidity conditions. Optimism is increasing throughout crypto as Bitcoin and US dollar broadly retains levels, which are 40% higher than at the start of the year.
Something that no one should trade on that specific thing, but it's more like an observation. And that part of the underlying causation, that correlation, is that generally that's the market kind of assessing that the Fed's getting close to being done its hiking cycle. And so that's kind of what happened last time, where when the 2-year rolled over the Fed funds, that ended up being the top of the hiking cycle, and that ended up marking the bottom of Bitcoin. And so right now, I think we're seeing shades of that. It doesn't mean that it's the exact bottom. It doesn't mean that the bottom's guaranteed in. But I do think that the part of the downward move in Bitcoin that was specifically from the dollar rally, I think that's kind of behind us. And now I think we probably have a longer grind ahead of us to, kind of start rebuilding from here. But, I think when you look in the second half of this year, there's still some liquidity concerns. And so kind of like how in the prior Bitcoin bear market, you had the major bottom in, say, late 2018 into 2019. That was the big bottom. But then you kind of had like a later liquidity shock through March 2020, where you went down and went up much faster. It was again another liquidity issue. I would be surprised something like that, like a sharp retest, but it's too early to say because it partially depends on what humans do, what Jerome Powell does, what different policymakers do, and of course that's always impossible to predict. I think there's still big things like that can move the crypto specific industry, but overall, like historically, Bitcoin has been very correlated to macro factors and specifically liquidity. And I've looked at it over the past couple of years because a lot of people, they look at the halving cycle. That's obviously got some degree of correlation. But then if you look at, say, Bitcoin and the Purchasing Managers Index, which is one of the leading macro indicators, generally when it's rising, it means the economy is expanding. Growth is accelerating. When that's going down, growth is decelerating. If it goes below 50, it's potentially outright contracting. And generally, Bitcoin's rather correlated with PMIs. It usually runs a little bit ahead of PMIs. Like it usually front runs it a little bit. And then I looked at it and saw that basically liquidity generally front runs PMIs, and Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense. But of course, if you have a big enough industry-specific blow-up, like we saw with FTX and like you might see with some of these others, that can temporarily override the macro factors because it doesn't matter if liquidity is good if there's some massive forced selling whale out there.
In her interview, Lyn Alden said, "I do think this is a deep value accumulation zone for Bitcoin with a 3 to 5 year view, but traders should be aware of the liquidity risks in the second half of this year. The Fed is currently conducting quantitative tightening, QT, removing liquidity from the economy to fight inflation after several years of mass liquidity injections, which began in March 2020. The unwillingness of large investors to participate in the market due to poor liquidity is evident from dwindling daily trading volumes on centralized exchanges. As Bitcoin climbed beyond $23,000 for the third time in 4 days before tumbling back as investors kept an optimistic eye on the macroeconomic situation, the recent narrative of declining inflation, gradually decreasing economic growth, and a U.S. central bank prepared to raise interest rates at a slower pace than in 2022 has helped Bitcoin bulls chase the unexpected. This is very discouraging for whales and larger trading firms actively trading crypto purely as an alternative publicly traded market, as there is considerable danger ahead of for the second half of 2023.
Of course, another factor to consider is not just the nominal rate, but also positive rates, right? So if you look at some emerging markets like Turkey, I mean, if you have, I don't have the numbers in front of me, let's say you had 80% inflation and you had 40% interest rates, is that tight? Of course not, right? So that's very loose. So a less extreme example is that if you have, 7% inflation and you have 5% interest rates, are you tight or are you loose? And the answer is that you're actually pretty loose. And so real yields are still negative in many ways of looking at it. Now the challenge there is that there's multiple ways to measure real yields because CPI is inherently a lagging indicator. It's backward looking, rates are forward looking, and so it's hard to do that apples to apples comparison. So there's things like break evens, which are basically ways to measure the market's assessment of forward inflation. But then the problem there is that it's usually very inaccurate. And they were not expecting inflation that we got in 2021, 2022. And so right now, overall, we're still not that tight relative to inflation. Although I think we're getting tighter as inflation comes down and as we stay at these tighter levels for longer.
The inflation picture is complex worldwide, but the current rally in Bitcoin and Ether seem to reflect a rising sense that America specifically is on a path to not only whipping inflation, but maybe even to a soft landing that stops inflation in turn. That's great news for risk-on speculative assets like crypto. Crypto assets have continued their decade-plus trend of steady, though volatile growth. While there are some significant regulatory risks on the table this year, that basic trend appears to be continuing. Crypto investors worried primarily about central bank interest rates are implicitly focused on speculative drivers of crypto price, including rising competition for dollars from safe investments like Treasury bonds. In turn, there is great news for risk on speculative assets like crypto, as it is expected that the Fed will soften its interest rate hiking agenda.
Yeah, I think 2023 is a transition year, just like 2022 was. So basically, 2020, 2021, you had this huge injection of liquidity. 2022, 2023, they're trying to pull some of that out. And I think you have to really kind of probably look into 2024, 2025 until you might see another round of liquidity. Now, these things are subject to change because it's based on actions we can't anticipate yet, human decisions. But generally, I think it's like this is a year where you want to build a good base, whatever it is that you do. You want to build a good base, whether it's a financial base, whether it's something you're working on, build that base and just kind of survive. Basically, don't necessarily expect things to boom this year. And it's going forward into the next cycle is when you want to have whatever you're building ready to go.
The future of the cryptocurrency industry has never been less certain. We have to figure out where the industry is going. 2023 is off to a precarious start, with the market higher but a lot of uncertainty in the air about economic and market conditions moving forward. What the rest of 2023 may hold, however, is still a topic of debate, and Alden suggests that it is naive to assume that the good times will continue unchecked. What are your thoughts on Lyn Alden's views about Bitcoin transition in 2023? Do you expect these assets to perform beyond investors' expectations in the coming days? Let us know in the comment section below. If you like our content, give this video a big thumbs up and do subscribe to our channel.